Money market is one of the most important and dynamic segments of the financial system. It is where trillions of dollars are exchanged every day, affecting the interest rates, inflation, and economic growth of countries around the world. But what exactly is the money market and how does it work? In this video, we will discuss about the money market in macroeconomics and see how it influences the economy and the monetary policy. The money market is mainly used by governments, banks, corporations, and other financial institutions to borrow and lend money for short periods of time, to meet their liquidity needs, or to invest their surplus funds. The money market plays a crucial role in macroeconomics as it determines the nominal interest rate, which is the price of money, and affects the aggregate demand, output, and price level of the economy. Without further delay, let's get started to understand money market in macroeconomics. Let's start with the understanding and components of the money market. The money market is composed of two main segments, the primary market and the secondary market. The primary market is where new money market instruments are issued and sold to investors, usually at a discount. For example, the government issues treasury bills, which are short-term debt obligations, to finance its budget deficit or to refinance its existing debt. The secondary market is where existing money market instruments are traded among investors, usually at their market price. For example, a bank that has bought a treasury bill from the government can sell it to another bank or to an individual investor before it matures to obtain cash or to earn a profit. The money market is also divided into several submarkets depending on the type and characteristics of the money market instruments. Some of the most common submarkets are the treasury bill market, where treasury bills issued by the government are traded. Treasury bills are considered the safest and most liquid money market instruments as they are backed by the full faith and credit of the government and have very short maturities, ranging from a few days to a few months. The treasury bill market is also the largest and most active submarket of the money market, as it is used by the government to conduct its monetary policy and by the investors to store their wealth or to hedge against interest rate risk. The commercial paper market, where commercial paper issued by corporations are traded. Commercial paper is a short-term promissory note or an unsecured debt obligation issued by corporations to finance their working capital or to meet their short-term obligations. Commercial paper usually has maturities of less than 270 days and is sold at a discount to its face value. The commercial paper market is mainly used by large and creditworthy corporations, such as banks, financial companies, and industrial firms, to raise funds quickly and cheaply, without having to go through the formalities of issuing bonds or stocks. The certificate of deposit market, where certificates of deposit issued by banks are traded. A certificate of deposit, or a CD, is a time deposit or a fixed-term deposit that pays a fixed interest rate and can be redeemed only at maturity. CDs usually have maturities of less than 1 year and are issued in denominations of $100,000 or more. The certificate of deposit market is mainly used by banks to attract deposits from large investors, such as corporations, pension funds, and insurance companies, and to lend them to other borrowers at a higher interest rate. The repurchase agreement market, where repurchase agreements or repos are traded. A repurchase agreement or a repo is a short-term contract where one party sells a security to another party and agrees to buy it back at a specified date and price. The difference between the selling price and the buying price is the interest rate, or the repo rate, of the transaction. Repos usually have maturities of 1 day to 1 week and are collateralized by high-quality securities, such as treasury bills, government bonds, or corporate bonds. The repurchase agreement market is mainly used by banks, dealers, and other financial institutions to borrow and lend money overnight or for a short period of time, to manage their liquidity and to finance their inventory of securities. These are some of the main submarkets of the money market, but there are also other submarkets such as the federal funds market, the banker's acceptance market, the euro-dollar market, and the money market mutual fund market that are also important and relevant for the money market in macroeconomics. Now that we have seen the definition and components of the money market, let's move on to the money demand and money supply curves. The money demand curve shows the relationship between the quantities of money that people want to hold and the nominal interest rate, which is the opportunity cost of holding money. The money demand curve is downward sloping, meaning that as the nominal interest rate increases, the quantity of money demanded decreases and vice versa. This is because when the nominal interest rate is high, people prefer to hold less money and more interest-bearing assets, such as bonds, to earn a higher return, and when the nominal interest rate is low, people prefer to hold more money and less interest-bearing assets to avoid a lower return. The money demand curve can also shift due to changes in other factors, such as the price level, the real income, the expectations, and the preferences of the people. For example, if the price level increases, the money demand curve will shift to the right, meaning that people will need more money to buy the same amount of goods and services. And if the real income increases, the money demand curve will also shift to the right, meaning that people will want more money to spend on their higher income. The money supply curve shows the relationship between the quantity of money that the central bank, or the monetary authority, creates and injects into the economy, and the nominal interest rate. The money supply curve is usually vertical, meaning that it is independent of the nominal interest rate and determined by the central bank's policy. The central bank can control the money supply by using various tools, such as the open market operations, the reserve requirements, the discount rate, and the quantitative easing. For example, if the central bank wants to increase the money supply, it can buy securities, such as treasury bills, from the banks or the public, and pay them with new money, or it can lower the reserve requirements, the discount rate, or the interest rate on excess reserves, to encourage the banks to lend more money to the borrowers. The money supply curve can also shift due to changes in other factors, such as the currency in circulation, the demand for reserves, and the multiplier effect of the banking system. For example, if the currency in circulation increases, the money supply curve will shift to the right, meaning that there is more money available in the economy. And if the demand for reserves increases, the money supply curve will shift to the left, meaning that there is less money available in the economy. Finally, let's see what are the implications of the money market for the economy and the monetary policy. The money market affects the economy and the monetary policy through the transmission mechanism of the interest rate, which is the link between the money market and the goods market. The interest rate influences the aggregate demand, which is the total demand for goods and services in the economy, and the aggregate supply, which is the total supply of goods and services in the economy, and thus affects the output, which is the total production of goods and services in the economy, and the price level, which is the average level of prices in the economy. For example, if the nominal interest rate decreases due to an increase in the money supply or a decrease in the money demand, the real interest rate, which is the nominal interest rate adjusted for inflation, will also decrease, and this will stimulate the aggregate demand by increasing the consumption, which is the spending by the households on goods and services, the investment, which is the spending by the firms on capital goods, such as machinery and equipment, and the net exports, which is the difference between the exports and the imports of goods and services. A higher aggregate demand will increase the output and the price level in the economy, and this will affect the aggregate supply by increasing the costs of production and the expectations of inflation. A higher aggregate supply will also increase the output and the price level in the economy, and this will create a feedback loop between the money market and the goods market until a new equilibrium is reached. In conclusion, we have seen that the money market in macroeconomics is a complex and fascinating topic that involves the interaction of the money demand and money supply curves, the determination of the equilibrium and disequilibrium in the money market, and the implications of the money market for the economy and the monetary policy. Subscribe to our channel for more videos on macroeconomics and other related topics.